Hi, this is Boris Schlossberg from BK Trader FX, and today I want to show you that trading does not have to be complicated in order to be effective. In fact, we're going to show you one of the simplest and easiest technical setups we ever have, but they can be extraordinarily efficient when traded correctly. We call this setup the RSI Rollercoaster, and the rules could not be more straightforward. Basically, what we're looking to do is the following. We want to sell overbought instruments and buy oversold instruments. In this case, we simply use the RSI, Relative Strength Indicator, as our indicator. But we put a little bit of a wrinkle to the whole setup. Most novice traders will simply want to sell anytime the RSI reaches a reading of 70 or above, or try to buy anytime the RSI reaches a reading of 30 or below. That can be a huge mistake because remember, something can stay overbought or oversold for quite a long time, and you really don't know exactly where a top or a bottom is. This is an example of the euro dollar over the last 3 years. This is a weekly chart of the euro dollar. And as you can see, what we try and do is actually not anticipate where the market is going to go, but have the market tell us the most likely location of its move. So, in the case of the RSI roller coaster, we'll wait until it reaches the overbought level, but then do not enter a trade until it actually comes off the overbought levels and dips down below the 70 level before we can initiate a trade. This tells us that basically prices have reached their near-term peak, and we have a good chance for making a turn trade. We have a good chance of catching a top, or if we're trading to the bottom of this, catching a bottom. So on this weekly chart, for example, we only have about 3 signals, but notice how effective they are. Here's a signal that was given to us. Let me just click on the chart and you'll see. This is a signal where the week prior, the reading was 71. As you can see, if I'm just going to put my cursor right over there. And the week afterwards, it dipped below the 70 handle into the 65 zone. We would have taken a short on the close of this week at 27.72. And our stop, typically, is about 10 points above the swing high. Why do we leave a stop about 10 points above the swing high? Precisely because of situations like this. Notice that the price action does give us the correct movement initially, but then has a little bit of a retrace, and in fact retraces all the way up to 29.76. The prior high was 29.70. If we had simply matched the high that was the prior high, it would have been stopped out virtually at the prior tick. So giving ourselves a little bit of elbow room, a little bit of breathing space, allows us to stay in a trade that may continue to work if we're correct. In this case, it does indeed work. It basically does a double top here and then continues to go down all the way until, I believe, 25.09. As a matter of fact, if you held on to this trade, the lower level here was 24.56. Remember, we entered this trade at 27.72, and our risk was 29.70, so about 200 points. And the move all the way down in this trade was all the way down to 24.81, so about almost 300 points. So 2 to 3 risk-reward ratio in terms of full potential. And that would have been a very, very nice trade. Moving on into the end of the year, we see that, for example, over here, this was not quite the RSI roller coaster. Here's an interesting example of where the setup just failed to trigger. Right over here, the actual reading was not 70, but 69.14. Now, clearly, every setup is as much an art as it is a science. So therefore, you could have possibly taken this setup if you wanted to, if you gave yourself a little bit of leeway. But if you stuck to the rules that it must go above 70 before it initiates any kind of an alert, and then dips below 70, this is a trade you would have passed up. However, as you moved over, let me just move this window over so you can see the prices. You moved over to this level over here. Again, it was at 71, and then next week over, it dipped below 70, triggering a trade. And this was a great trade because here we entered at 35.93. The high over here was 36.84, so 36.94. That would have been a 100-point risk. And the move here was all the way to 33.57. It was almost a 400-point move. It was a 1-to-4 risk-reward type of a trade that would have worked quite well as we entered into it. Now here's a trade where, again, we moved into the 70 zone. It broke below the 70 into the 60 zone. We would have triggered over here. This would have been a little bit of a lower entry. We entered at 36.35. Our high here was 38.51, so almost about a little bit more than 200 points of risk. But even with that, we were pretty much caught at the top. We stayed in the trade for a couple of weeks, and the thing went all the way down to 33.59, would have given us almost 300 points of potential profit. So as you can see here on a weekly chart, we had 1, 2, 3 trades, all of which provided us with very nice profit. But this is the critical thing about that. It may be simple, but it's also very important to remember that it works best on longer term time frames when you have the most amount of data, the most statistically valid information, and therefore the most accurate and precise setups. If we were just to go down to the daily level, and let's just do that, we're going to go to daily level on 3 years, you'll see that it does set up a lot of signals as well, more signals than before, but some of the signals actually fail. Here's a signal that pretty much failed. I think I'm just going to show you the failures because I think it's very important to see that this setup is not always ironclad. Here's a signal where I believe, okay, went up to let me see, 66, 69. Here's a signal where it went to 70, and then it came off the 70 handle over here to 68, and actually took out the high on the dailies. It took out the high before it turned. And this happens more and more frequently on the lower time frames that you go to, meaning that you're going to get a few fake outs. But here's the great thing about this setup. Even when you get stopped out, your losses are quite small because you're basically selling at or near the top. And you know, if it does rally a little higher, you can stop yourself out for a small amount. And then enter the next trade or the next trade, because after 1 or 2 false signals, you're going to get a right signal that's going to move 200 or 300 points your way, as it does here on the dailies. Now, if you want to take this setup for even a lower time frame, let's say on a 4-hour time frame, here's a 40-day 4-hour time frame. I'm going to snap out of this a little bit lower. You'll see that again, it sends out more and more false signals. Here's an example where it sends out even more false signals all the way through here. It's in the 70s. It dips down a little bit below and then dips back up. So you're going to be vulnerable and subject to more stop outs and more fake outs on the lower time signals that you go to. And of course, if you were to go all the way down to the hourly time frame, let's just go to the hourly time frame just for kicks, and you'll see that there was several times here where it went into the 70 zone and just basically consolidated. Because remember, the RSI Rollercoaster basically tries to pick tops and bottoms, and the flip side of something is that even though it can show you a top, there's 2 resolutions. It can go down and move off the overbought territory, or could simply consolidate across and work off the overbought conditions and then rally higher. On the lower time frame you go to, on the shorter time frame you go to, you're much more vulnerable and subject to that kind of risk. So the key thing to remember with this setup, it's incredibly simple, very powerful, but most effective on the longer term time frames. Yet even on the shorter term time frames, however, you could use it quite efficiently, because remember, every time you're getting stopped out for very, very little amount of money, and every time you're catching a turn, you actually can catch some very nice moves. So here, for example, let's just take a look at moves over here. You're getting stopped out here for over here you would be catching maybe 20, 30 points. Remember, this is trading on the hourly time frames. But if you were to go back a little bit more when we had less of a trending environment, here's an environment, by the way, where actually we could have caught the lower end of it. If we bought over here, you had a very small amount of risk, maybe 20, 30 points, and a much higher 50, 60, 70 points of profit on the upside. Here again, you had on the lower overbought, if you bought here, virtually no risk and very, very high reward. But remember that the lower time frame was always going to cause you more stop outs. This is true across the board. This is why technical analysis doesn't apply the same idea universally across the board, and the key to being an effective technical trader is to know which time frames you want to apply this idea best for.